Very good evening, everyone. So we are meeting on this Sunday evening for the purpose of revision session on ratio analysis. So we're going to do a revision and maybe practice few questions on the topic of ratio analysis. Okay, so let me take few questions so that we can recap and also practice questions on this topic of ratio analysis. So let me just come up with the question sheet. Yeah. So here we have few questions on ratio analysis. Let us take them one by one. So let us look at this question number 1. The first question that we have. So let me just copy it. So we paste it over here. Question number 1. Based on the following information, prepare the balance sheet of Stellar Limited as at 31st December. So as on 31st December, we have to prepare the balance sheet of this company, wherein we have the information of current ratio, liquid ratio, net working capital, stock turnover ratio, gross profit to sales, COGS to net fixed assets, average debtors collection period of 2.4 months, fixed asset to net worth of 0.8, and long-term debt to capital and reserves. That's 7/25. So going by this, first, let us try to have the broader format for this particular question. We need to be very clear what are the things in the balance sheet we need to compute. So as far as balance sheet is concerned, we do have the current ratio and liquidity ratio. So definitely we are going to have current assets, and within that current assets, we are going to have stock and other current assets. And of course, the total of that will be coming out on the other side. Current assets with the stock and other current assets. Then liquidity ratio is also, we are going to also calculate the current liabilities portion. So in the liabilities part, we have current liabilities. So net working capital is okay. Stock turnover ratio, gross profit to sales, and then you have the COGS to net fixed assets. So definitely we'll have the net fixed assets also to be computed. Net fixed assets will be computed. Average debtors collection period. Okay, so apart from this, we're going to have the average debtors collection period. So we need to have the value of debtors also. And then we will have the other current assets. Total will be placed on the outer column. So you have to compute the net fixed asset, stock, debtors, other current assets, total current assets, current liabilities. Okay, then fixed asset to net worth. And then we have long-term debt to capital and reserves. So we'll just have one item over here as net worth, which will be equity share capital plus reserves. And also we will have long term debt. So these are the values that we need to compute. Okay. So can we calculate these values? Would you like to try it initially from your end? Okay. So would you like to solve it or shall I take it up? Yes, we'll solve it. Okay, good. Try it out, guys. So let us try to solve it in a time-bound manner. So when we say time-bound manner, let's have a timing for this question. Ideally, you should be able to solve it within 7 minutes. So let me start with the timer also here. So 7 minutes is the ideal time which you should be taking to solve this question. Okay, so here we have the timer and also the question in front of you. Go ahead with this. I think, Pooja, you should be able to see the question. You're able to see the question, right? Okay, perfect. Go ahead, guys. Try to solve it. 7 minutes. So are we done? Are we done or you need some more time? Did we get the answers? Asset side as well as the liability side. Are you getting answers or you're finding it difficult? Yes. Need more time? Okay. Take another 5 minutes. This question can be for, you know, approximately not 5 marks, but definitely more than that, 7 or 8 marks. You should be able to solve it with all proper format and everything with around what, 15, 16 minutes. So anyways, we've taken you 7 minutes, so you can take 5 more minutes. Okay, I think we should be done now. So let me just give the answer to this. Let me just provide the answer to this. Yeah. So first up, current ratio of 2.5. So when you look at this current ratio of 2.5, how do we get the answers for this? So current ratio is 2.5. So we can say the connected number that we have is net working capital of 6 lakh. So we say that current asset minus current liability is 6 lakh, and current ratio is basically current asset upon current liability is 2.5. Okay, current asset upon current liability is 2.5. So we can definitely say current asset is 2.5 times of current liabilities. So we can substitute here 2.5 current liability minus current liability is 6 lakh. So 1.5 times of current liability is 6 lakh. So what is current liability? It is 6 lakh divided by 1.5. The 6 lakh divided by 1.5. How much is your current liability? I think 4 lakh. Yeah, correct. So we got the current liability as 4 lakh, and current asset is 2.5 times of current liability. So it is 2.5 into 4 lakh. So 2.5 into 4 lakh, it is 10 lakhs. Okay. So we had the current assets as 10 lakh and current liability is 4 lakh. Okay. Now, after that, we have the liquid ratio, which is 1.5. So liquid ratio is 1.5, and this is your current asset minus stock upon current liability. So 1.5 will be equal to 10 lakh of current asset minus stock is something which you have to compute upon current liability, and we know current liability is what, 4 lakh. So the value of stock is 1.5 into 4 lakh. 1.5 into 4 is 6 lakh, and then that goes on the other side. So what is the stock value? What is the stock value? You need to get the stock, right? So 4 and this is for 4 lakh. Stock is 4 lakh. No, 6 lakh. Yeah, 4 lakh. Yeah. Stock is 4 lakh. So we got the value of stock also as 4 lakh. Okay, fine. Then net working capital. Stock turnover is 5. So since they're saying stock turnover is 5, so our stock turnover is 5, which is going to be COGS upon stock. So 5 is equal to COGS upon stock of 4 lakh. So COGS will be 20 lakhs. Got it? So stock turnover is 5. So COGS upon stock is 5 equal to COGS upon 4 lakhs. So COGS is 20 lakhs. So we can say COGS is 20 lakh, but we need to look at the gross profit to sales, because from that we are going to get the COGS to net fixed assets, and also sales will be available for calculating the debtors. So COGS to net fixed assets ratio, let's use that. COGS upon net fixed asset is 2. So COGS is 20 lakh upon fixed asset is 2. So fixed asset is 10 lakh. Okay. Fixed asset We got it as 10 lakh. Fixed asset is 10 lakh, right? How come, Pooja, you're getting 24 lakh fixed asset? Hmm. Fixed asset is 10 lakh, everyone. Others, just verify. You're getting fixed asset as 10 lakh? Yes, okay, correct. Fine. So 10 lakh is done. Then we will use the average debtors collection period and sales. So since your COGS is 20 lakh and gross profit to sales is 20%. So GP ratio is 20%. GP ratio is 20%. So we can say since GP ratio is 20%, sales minus COGS upon sales is 20%, or we can say 0.2. So sales minus 20 lakh upon sales is 0.2. So what is the sales value? What is the sales value? What the sales value is? 25 lakhs. Sales value is 25 lakhs, correct. Okay, so we got the sale value as 25 lakh, but that sales is not going to be entering my balance sheet. But the value connected with the sales, which is the debtors, will be calculated because average debtors collection period is 2.4 months. So debtors collection period is 2.4 months, right? So we can say what will be the debtors value? Debtors will be equal to 25 lakh into 2.4 by 12, because out of the entire sales, 2.4 month sales is outstanding as debtors. So 25 lakh into 2.4 divided by 12, which is 5 lakh. So we got the value of debtors also as 5 lakh. Other current assets will be definitely the balancing figure of 1 lakh. Okay. So now we have the long-term debt and net fixed asset. We have the ratio as net fixed asset to net worth as 0.8. Net fixed asset to net worth is 0.8, and where fixed asset was 10 lakh. So 10 lakh upon net worth is 0.8. So how much is going to be the net worth? How much is going to be the net worth? 12 lakh 50,000. Yes. Net worth is 12 lakh 50,000. So we got this value as 12 lakh 50,000. And then the number that we have finally is long-term debt to capital and reserves. So it is like long-term debt upon net worth. Long-term debt to net worth is 7 by 25. Okay, so long-term debt upon net worth is 12 lakh 50,000. That is 7 by 25. So what is the value of long-term debt? 12 lakh 50,000 into 7 divided by 25, which is 3 lakh 50,000. So long-term debt is 3 lakh 50,000. So balance sheet tally is at 20 lakhs. Correct, everyone? Did we get this? The balance sheet tallying figure at 20 lakhs, right? Balance sheet tallies at 20 lakhs. Gross profit ratio. Okay. The GP ratio is 20%. So it's going to be gross profit upon sales. It's going to be gross profit upon sales. And gross profit is sales minus COGS. Got it? Sumit? Okay. Fine. So that was this first question. Now, let's go for the second question. Now, the second question, guys, I am not going to help you in any ways. You have to solve it fully on your own. Will you be able to do it? No format, nothing. In the previous question, I gave you the format. In this, you have to determine the format on your own. Can you do it? Yes, Pooja?
सर इन दिस क्वेश्चन सर मैंने ना पीछे बहुत सारे क्वेश्चन किए हैं उसमें दिया होता है कि फिक्स एसेट्स टू नेटवर्थ जैसे कि 0.8 दिया है
हाँ
और
हाँ
वर्किंग कैपिटल टू नेटवर्थ 0.2 मतलब 100 में से माइनस करके दिखाते हैं और फिर उससे सॉल्व करते हैं लेकिन इस क्वेश्चन में ऐसा किया तो मतलब मेरा सारा ही क्वेश्चन गलत हुआ है
नहीं नहीं, व्हाट डिड यू डू? आपने क्या किया?
सर जैसे क्वेश्चन
फिक्स्ड एसेट टू नेटवर्थ इज 0.2, बराबर?
0.8 दिया है
हाँ,
फिक्स एसेट्स टू
0.8। हाँ,
नेटवर्थ 0.8
तो हाउ
तो
कैन यू से दैट
वर्किंग
वर्किंग क्या?
कैपिटल
नहीं 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 नहीं, आप वर्किंग कैपिटल फिर 0.2 कैसे लोगे बेटा? तो इसका मतलब आप बोल रहे हो कि नेटवर्थ आपका 1 है और फिक्स्ड एसेट 0.8 है, तो ये 0.2 होगा,
यस
बराबर?
सर
लेकिन
सर एक्चुअली हाँ
ले,
उसमें लॉन्ग टर्म डेट नहीं दिया होता
हाँ,
तो
तो लॉन्ग
अगर
टर्म
लॉन्ग
डेट।
टर्म डेट
हाँ, लॉन्ग टर्म डेट दिया ना इधर, उसका इन्फॉर्मेशन दिया ना लॉन्ग टर्म डेट का।
सिर्फ इसी वजह से मेरा क्वेश्चन गलत हुआ राइट सर
हाँ
अगर ये
हाँ
इंफॉर्मेशन नहीं होती तो मेरा क्वेश्चन ठीक होता
हाँ, तो आपने लास्ट ये वाला रेशियो आपसे चूक गया, यू डिडंट डू दिस,
ओके सर
है ना? तो यू मे फेस, मतलब फिर आपका बैलेंस शीट ही गलत अमाउंट पे टैली होगा।
और सर एक और बात जैसे ये जीपी रेशियो 0.2 पे है तो सीओजीएस रेशियो 0.8
कर
होगा तो
सकते हो,
हम
वो कर
डायरेक्ट कर
सकते
सकते
वो कर सकते हो।
हैं
यस यस, वो
ओके
कर
सर
सकते
थैंक यू सर
हो। चलो, सो क्वेश्चन नंबर 2, विल यू सॉल्व इट एवरीवन? यस और नो? Just I'll give you idea about statement of PL a bit, because there is somewhere, we may find challenging. So in this PL format, prepare the profit and loss in this format. See, because if you look at this, they're given you net profit, variable cost information is given, right? And then you have the EPS number also, EBIT to PBT. So the format should be very clear in your mind. You start with sales less variable cost, which will give you contribution, less fixed cost, which will give you EBIT. And then you subtract the interest to arrive at PBT. You subtract the tax to arrive at PAT. I don't think. Is there any preference share information given? Current ratio, asset ratio, EPS to EPS is given, book value per share, net working capital. Okay, there's no preference share given. Okay. So of course, this question is going to require a good amount of time. So I'm going to give you total time of 15 minutes for this, because you will take substantial amount of time for this. So 15 minutes is a decent amount of time for this question. Start this. Okay. Are we ready with the solution? Are we ready with the solution? Okay, let me start. From the following information and ratios, prepare a statement of profit and loss and balance sheet, assuming 1 year as 360 days. Ignore taxation. So current asset to stock ratio is 3:2. Current ratio is 2. Asset test ratio is 1. EBIT to PBT is 2.2. EPS is 10. Book value per share. All these are just numbers given to us. The only thing that is given to us, in the form of rupee terms, is net working capital. And the only ratio that we can connect with net working capital is current ratio. So let me first prepare the format of the balance sheet. Over here, we'll need fixed asset. Then we'll, of course, need the current assets. In that current asset, since we are having asset test ratio or the liquid ratio, we'll definitely have stock. Is there any information about collection period? Yes. So we will also have debtors, then other current assets. On this side, you'll have current liabilities. Then you have long-term loan or long-term debt. Then net working capital, okay, liabilities to net worth. Now, of course, the net worth will be comprising of variable cost, net profit to sales, net working capital. It's just going to be the net worth or the own fund. So let's start one by one. So current ratio is 3. So current ratio is 3. We can definitely apply the current ratio formula. So current ratio is 3. So current assets upon current liabilities is 3. We simply say that current asset is 3 times of current liabilities. Current asset is 3 times of current liabilities. And then we have this net working capital or current asset minus current liabilities. So current asset minus current liabilities net working capital is 10 lakh. I think you should be able to, solving these two, you should be able to get the current asset and current liabilities. How much is the current asset and current liabilities? Current asset is 15 lakh. Current liability is what? 5 lakhs. Everyone? Current asset is 15 lakh. Current liabilities is 5 lakh. Yes. So the total of current assets is 15 lakh and current liability is 5 lakh. Okay. So current asset is 15 lakh. Current liability is 5 lakh. Then after that, asset test ratio is 1, which is also the liquid ratio. So liquid ratio is 1, which simply means current asset minus stock upon current liabilities is 1. So this is 15 minus stock upon current liability is anyways 5. That's equal to 1. So what's the value of stock, guys? Value of stock is what? 10 lakhs. So stock is 10 lakh. Okay. Asset test ratio is done. EBIT to PBT, that we will do it later. EPS also later. Book value also later. Average collection period is 20 days. But for that, I need the value of sales. And the sales is something that's not given, but we have the stock turnover ratio given to us. The stock turnover ratio is 5. So stock turnover ratio is 5. So I'll say stock turnover is sales upon stock is 5. So we can get the sales upon stock. Stock is 10 lakh, which is 5. So the sales value is going to be what? 50 lakh, right? So in the P&L, we'll write this as 50 lakh. Variable cost is 60%, so variable cost will be 30 lakhs. So we get a contribution of 20 lakh. Then subtracting the fixed cost, that we'll have to compute it later. We got the stock, we got the sales. Then EBIT to PBT ratio is okay. EBIT to PBT, so we'll get the interest from that. Book value average collection period is 30 days. So we'll get the value of debtors. Debtors will be 50 lakh into 30 days. So 30 days is the question saying to assume 360 days. Yes. So into 30 by 360. How much is the debtors? 50 lakh into 30 by 360. So 50 into 30 by 360. Debtors is what? 4 lakh 16,667. Are we getting this? 4 lakh 16,667. That is the value of debtors. And 83,333 is the other current assets, the balancing figure. Okay. Then we have the fixed asset turnover as 1.2. So since our fixed asset turnover is 1.2, this simply means that it is sales upon fixed asset is 1.2. Okay. So fixed asset turnover is 1.2. So we get the sale value as 50 lakh upon fixed asset is 1.2. So what will be the fixed asset value? Fixed asset value 50 divided by 1.2, which is 41 lakh 66,667. Yes. So that's your fixed asset turnover, which is 41 lakh 66,667. Okay. So asset side is ready. Now we have the total, fixed asset turnover collection book value per share is okay 40. But then net profit is 10%. Net profit to sales. So you can get the PAT ratio, profit as what? 5 lakh. Because the net profit ratio is 10%. Then long-term interest rate is 12%. That's not there. So how do we go about the other parts now? So what we need is the value of net worth and long-term debt. So variable cost to sales is done. Long-term, this is of no use. Net profit is computed. Total liabilities to net worth is 2.75. Total liabilities, which is total of these liabilities to net worth, is 2.75. Total liabilities to net worth is 2.75. So how do we get that value now? Of course, the total of assets is available with us, which is total of assets is how much? 41 lakh 66 plus 15. So 41.6 plus 15, which is 56 lakh 66,667. Of course, this should be 56 lakh 66,667. Now we don't know what's the net worth, what's the long-term debt, right? But we do have a ratio of total liabilities to net worth. So we'll say total liabilities to net worth. Total liabilities to net worth is 2.75. So total liabilities is going to be long-term debt plus 5 lakh divided by net worth is 2.75. So we had an equation as long-term debt plus 5 lakh is equal to 2.75 net worth. So we have long-term debt minus 2.75 net worth is 5 lakh. Okay. Then the other side is total of all should be equal to 56 lakh 66,667. So net worth plus long-term debt plus 5 lakh is equal to 56 lakh 66,667. So you just need to solve these two equations and get the value of, this is your equation number 1, this is equation number 2. Solve them and give me the value of long-term debt and net worth. Solve them simultaneously and give me the value of long-term debt and net worth, everyone. So what's the value of long-term debt and net worth? So net worth is what? 15 lakh, 11,111. And what about the long-term debt? Long-term debt is 36 lakh 55,556. Okay. So we get 15 lakh 11,111 and this is 36 lakh 55,556. Okay. That's your balance sheet. Now, of course, the interest amount is what we can compute. This is 36 lakh 55,556 into interest rate is given, right? 12%. So if it is interest rate is 12%, we can say 36 lakh 55,556 into 12%. So interest is 4 lakh 38,667. That's your interest. Then we have EBIT to PBT ratio. EBIT to PBT ratio as 2.2. So EBIT upon EBIT minus 4,38,667 is equal to 2.2. From this, you can get the EBIT value. Net worth calculation. This is solving both these equations. Sumit, you have an equation long-term debt minus 2.75 net worth equal to 5 lakh. And other is net worth plus long-term debt plus 5 lakh is 56 lakh 667. So you just need to solve both of them simultaneously. Okay. What net worth is 29 lakh 52. Is it? Let me solve it then. So it is net worth plus long-term debt is 51 lakh 66,667. This is my second equation. Okay. I just write this next equation minus 2.75 net worth plus long-term debt is 5 lakh. So we're going to subtract. So if we subtract, this becomes 3.75 net worth is equal to 46 lakh 66,667. So if we just divide this 46 lakh 66,667 divided by 3.75. What? It is 12 lakh 44,000. So this is incorrect. Net worth and long-term debt. Net worth seems to be incorrect calculation. So we have net worth plus long-term debt plus 5 lakh as 56 lakh 66,000. So 5 lakh going there. You will be left out with 51 lakh 66,667. So you have net worth plus long-term debt, and here you have minus 2.75 plus long-term debt equal to 5 lakh. Then when I subtract it, net worth minus this, minus of minus becomes positive 3.75. Net worth minus, and then they have, after subtracting this, so net worth, you've provided me a wrong answer. It is 12 lakh 44,444. 12,44,444. And then you have the long-term debt as 12,44,444 plus 5 lakh minus 56,66,667. So that's 39 lakh. Long-term debt is 39 lakh 22,223. This is the accurate one. As you see, this has what? Total liabilities to net worth. This is 2.75. So total liabilities is what? 39 lakh 22,223. So this divided by 56 lakh 66,667. That's total liabilities to net worth. Total liabilities is what? 44 lakh 22,223 divided by 12 lakh 44. No, 39 lakh 22,223 plus 5 lakh. This is your total liabilities. This divided by 12 lakh 44 444. Total liabilities is 2.75. This is, I don't know, some mistake in this calculation. So you have long-term debt plus 5 lakh upon net worth is 2.75. So long-term debt plus 5 lakh equal to 2.75 net worth. We put it other side. So long-term debt minus 2.75 net worth is 5 lakh. And then on the other side, you have net worth plus long-term debt plus 5 lakh. Net worth plus long-term debt is equal to 56 lakh 66 667. How is this being mistaken? Yeah, I think there is some mistake of, I don't know, 12 lakh 44, because the rule is what? Total liabilities to net worth. Total liabilities is this. Total liabilities is long-term debt plus 5 lakh upon net worth is 2.75. Equation 1. So total liabilities is 39 lakh 20, long-term debt plus 5 lakh upon this net worth is 2.75. So long-term debt plus 5 lakh is 2.75 times of net worth. You have long-term debt minus 2.75 net worth as 5 lakh. And then on this side, you have net worth plus long-term debt plus 5 lakh is 56 lakh 66 667. So that goes on the other side. You have 5 lakh subtracted from that, which is 51 lakh 66. And then I subtract this long-term debt. This is 2.75 net worth. And this we have 5 lakh. Then we are subtracting it. So 3.75 net worth plus 2.75 is 56 lakh. It is minus 1 lakh in equation 1. Yeah, correct. This is minus 1 lakh. So this becomes plus. Yeah, this becomes 56 lakh 66 667. So net worth is 56 lakh 66 67 divided by 3.75, which is, yeah, 15 lakh 11,111. Okay, so correct. I mean, the previous values were correct. Yes. So net worth is 15 lakh 11,111, and long term debt is 41 lakh 55 556. Okay. No, long term debt is 36 lakh. My bad. Okay. So that gives us this answer. Now, of course, solving this will provide us with EBIT answer. So EBIT will be 2.2 into 4 lakh 38 667, which is 9 lakh 65. So this is what, 9 lakh 65 067.4, and you have that as 1.2 EBIT. So this divided by 1.2, it gives us the EBIT value as 8 lakh 4,222. So we have the differential figure as the fixed cost, which is 11 lakh 95,000, 20 lakh minus 804,222, which is 11 lakh 95,778. Then you have the PBT value, 8 lakh 4,222 minus 4 lakh 38 667, which is 365,555. Okay, so PBT is 365. So how come PAT, net profit to sales, is 10%? So how come this is 5 lakh? How can net profit be direct PAT? Net profit is obviously PAT. So there is something, ignore taxation. They're saying ignore taxation. So there is no tax which is there over here. The PBT itself, your answer stops at PBT. There is something problematic. I mean, this particular net profit to sales ratio, this is incorrect maybe. Right. Okay. So with that, we are through with this. Let's just take a break now, and after the break, we'll do maybe a couple of more questions on this ratio analysis. Let's take a break now, guys. Hello everyone. Have we resumed back? Everyone, have we resumed? Okay, so let's take up this question now. So we have the information about the debt to equity ratio, return on shareholders fund operating ratio is given. Ratio of operating expense to COGS is given. Tax rate is 25%. Fixed asset is 39 lakh. Current ratio is 1.8:1. So we have to compute the interest coverage ratio, gross profit ratio, and current assets. Okay. So just try to solve it. Again, we have to compute the three ratios over here: interest coverage, gross profit, and current assets. Okay, so I think you should be able to do it within 10 minutes. Start with it, guys. Try it out. Okay, so let's look at the answer for this now. Mm, the information is provided with regards to debt to equity ratio, return on shareholders funds, operating ratio, ratio of operating expense to COGS, tax rate of 25%. Fixed asset is 39 lakh. Current ratio is 1.8:1. We are required to calculate the interest coverage ratio, gross profit ratio, and current assets. Okay. So with regards to the information, we have first up interest coverage. So for interest coverage ratio, we need EBIT upon interest. So I need to compute the amount of interest. Well, interest we can compute. Interest is simply 12.5% into 45 lakh. So which is 45 lakh into 12.5%. So 45 lakhs into 12.5%. Interest is 5 lakh 62 500. Okay, that's your interest. Now I need the amount of EBIT. So for EBIT, we have debt to equity ratio. Debt is given to equity. We can calculate return on shareholders funds is given. So let us first compute the amount of equity. Since debt upon equity, debt to equity is 1.5. So since this debt upon equity is 1.5, and we see that debt is what debt is 45 lakh. So 45 lakh upon equity is 1.5. So we get the value of equity as what? Equity is 30 lakh. Right. So equity is 30 lakhs. And then we say return on shareholders fund is 54%. So PAT will be 30 lakh into 54%. Okay, so PAT is return on shareholders fund is 54 lakh. 54% of 30 lakhs. How much is this? 30 lakhs into 54%. How much is this value? 30 lakh into 54%. So PAT is 30 lakh into 54%, which is 16 lakh 20,000. That's your profit after tax. And of course, we can get the profit before tax also. So profit before tax is 25% is the tax rate. So 16 lakh 25,000 divided by 1 minus 0.25, 25% being the tax rate. So 16 lakh 20,000, 16 lakh 20,000 divided by 0.75. So PAT is 21 lakh, sorry, PBT is 21 lakh 60,000. Okay. Okay, so PBT is 21 lakh 60,000. I can get the EBIT as PBT plus interest. So PBT is 21 lakh 60,000. On that, we add the interest of 5 lakh 62 500. So we get the EBIT value as 21 lakh 60,000 plus 5 lakh 62 500, which is 27 lakh 22 500. So interest coverage ratio is going to be 27 lakh 22 500, which is EBIT, upon the interest expense of 5 lakh 62 500. So what's the interest coverage ratio? 27 lakh 22,500 divided by 5 lakh 62,500, which is 4.84 times. That's your interest coverage ratio, 4.84 times. Interest coverage ratio. Got it? Then we have to compute the gross profit ratio. Now for gross profit ratio, ratio of operating expense to COGS is given as 2.6. Fixed asset is okay to 39 lakh, and then current asset and other things are there. But now to compute the gross profit, I need to calculate the fixed expense, and your operating ratio is 85%. Operating expenses to this is 2:6. So since your operating ratio is 85%, operating ratio is 85%. How do we get the operating ratio? Operating ratio is your COGS plus other operating expense upon sales. Okay. And we have the information also, ratio of operating expense to COGS. Okay. So operating expense to COGS, this ratio of operating expense to COGS is 2:6 or 1/3. So we can definitely say, sir, operating expense, I can write it as COGS into 1/3. The operating expenses 1/3 into COGS. So let us just say this is to be COGS plus 1/3 COGS divided by sales. Okay. So we can say 85% is going to be equal to COGS plus 1/3 COGS. That's going to be 4/3 COGS by sales. 85% is 4/3 COGS by sales. Now, how do we really get the other part? So 4/3 part of COGS, we can think it the other way around a bit of, since your operating ratio is 85%. Okay. Your operating ratio is 85%, which means 4/3 times of COGS by sales is 85%. But this way, you can't be actually getting what is the value of COGS, because what we want is COGS number. But of course, yes, we can say COGS by sales is 85% into uh, yeah. So COGS is going to be 85% into 3/12. 85 into 3/12. Sorry, into 3/4. 85 into 3/4, which is 63.75%. So of course, if COGS is 63.75%, therefore GP is going to be 100% minus 63.75%. So your GP is 36.25%. Your GP is 36.25%. Gross profit ratio is working out to be 36.25, because we get this as a COGS ratio. COGS, since your COGS is 63.75, your GP is going to be 36.25%. Okay. Fine. So that's your GP ratio. Next is going to be the current ratio, current assets, sorry. So for current assets, we have the current ratio given to us. Okay. And only the current ratio is given. There is no other information which is provided. So current ratio is 1.8. Your fixed assets is 39 lakh. So, to compute the other aspects, we'll have to prepare the balance sheet and then try to get the values. So in balance sheet, we have fixed asset of 39 lakh. Current asset is something we don't know. Okay. And then on the other side, we have the equity. Equity is 30 lakhs. We have the debt value given to us. So debt is how much? Debt is given to us as 45 lakhs. So of course, we have the current liability also given. So current liability is something which we don't know. But we know that current asset upon current liabilities. Current asset upon current liability is 1.8. Okay. So since we know this part, therefore we say current asset is 1.8 times of current liabilities. Then we'll say total assets. Total assets is going to be equal to 39 lakh plus current asset. Total liabilities is going to be 30 lakh plus 45 lakh plus current liabilities. Okay, and of course, we can just substitute here and say that this is 75 lakhs plus 1.8 Okay, just one second. This will remain as it is. Sorry. This will be plus current liabilities, and this will be written as 39 lakh plus 1.8 current liabilities. So this is 39, 30 plus 45, which is 75 lakh plus current liabilities. 39 lakh plus 1.8 current liability and 75 lakh plus current liability. We have to be saying that both of them should be equaling each other. So 39 lakh plus 1.8 current liability is 75 lakh plus current liabilities. So we can solve this and get the value of current liability. How much is the current liability in this case? So 75 lakh minus 39 lakh divided by 0.8. So current liability is 45 lakh and current asset will be 1.8 current liability, which is 45 lakh. This is into 1.8. 81 lakh is the value of current asset. Okay. Got it, everyone? Yeah, Pooja?
Sir, EBT is 21,60,000.
EBT?
Yes, sir.
Yeah, PBT is 21,60,000. Yes.
तो सर अगर हमें ईबीआईटी निकालना है तो हम 21,60,000 डिवाइडेड बाय 87.5% भी तो कर सकते हैं, लेकिन ये अमाउंट हमारा गलत आ रहा है, क्यों? जबकि डेट जो है वो डेट
87.5% कहाँ से आ रहा है तुम्हें?
सर 12.5% डेट है। अगर
अरे
हम 100
ट्वेल्व पॉइंट
माइनस
फाइव
12।
परसेंट इज द रेट ऑफ इंटरेस्ट.
यस सर।
वो तो रेट
अगर
ऑफ
100
इंटरेस्ट,
माइनस
तो दैट इज
12.5।
12.5%. 12.5% वो 45 लाख का होगा. दैट इज यूज टू कंप्यूट द इंटरेस्ट. दैट इज नॉट अ रेशियो और proportion ऑफ योर प्रॉफिट.
ओके सर, मैं इसी वजह से कंफ्यूज थी, मैंने
हाँ
इसको इससे डिवाइड कर दिया था
हाँ
87.5।
हाँ, ना ना, वो तो परसेंटेज प्रॉफिट के लिए.
ओके सर, थैंक यू सर।
यस गर्व.
सर मैंने जब कैलकुलेट किया था ये अपना ईबी अपना ऑपरेटिंग इनकम को ईबीआईटी से इक्वल ले लिया था, फिर आंसर सेम आया, बट ये कोइंसिडेंटल है, ये हम ले सकते हैं
ऑपरेटिंग इनकम को EBIT सेम.
ईबीआईटी के इक्वल।
ऑफ कोर्स ऑपरेटिंग इनकम इज डेफिनेटली EBIT. यस, करेक्ट. Okay, yeah, Vedant. What is the doubt you have in GP ratio? What's the doubt? Okay. Calculation of COGS for operating expense ratio explanation. So you computed the COGS upon sales, right? Your operating ratio is given as 85%. And your operating ratio will comprise of what? COGS plus other operating expense divided by sales. So it is COGS plus 1 by 3 COGS, right? Because they're saying that other operating expense is 1/3 of COGS. That ratio is given, right? You see, operating expense to COGS. So operating expense to COGS is 1 by 3. So operating expense is 1 by 3rd of COGS. And then that comes out to be 4 by 3. And then you get a COGS ratio as 63.75. So of course the balance 36.25 will be your GP ratio. Okay. Okay, try out this question number 11, everyone. You have to compute the inventory turnover ratio. Inventory turnover ratio. The inventory turnover ratio. So inventory turnover ratio, we know it is COGS upon average inventory. So formula is COGS upon average inventory. So try to calculate this. It should take around not more than what 3 minutes. So not more than 3 minutes. Try to calculate the inventory turnover. First, you need to get the average inventory by taking the average of opening and closing stocks. And then you compute the COGS. COGS will be opening plus purchases plus other operating expenses. I mean, basically manufacturing expense minus the closing stock. Okay, so what is the average inventory number? Average inventory is going to be opening stock plus closing stock divided by 2. So opening stock is 62,000 plus closing stock is 54,000 by 2. So this comes out to be average stock is how much? 62,000 plus 54,000 divided by 2, which is 58,000. So average inventory is 58,000. Now, after average inventory calculated at 58,000, I need to get the COGS number. The COGS is opening stock plus purchases plus manufacturing expense minus closing stock. So opening stock is 62,000 plus purchases and other expenses 2,60,000 right? And of course, all manufacturing expenses are included here in this 2,60,000, less the closing stock of 54,000. So what is the COGS value? 62,000 plus 2,60,000 minus 54,000. COGS is 2,68,000. And then we have the inventory turnover. Inventory turnover is COGS upon average stock. COGS is 2,68,000 divided by average stock is 58,000. So 2,68,000 divided by 58,000, which is 4.62 times. So inventory turnover is 4.62 times. Yep, got it. Depreciation, unless and until stated, we are going to be including as a part of our manufacturing expenses. Okay. And of course, all your production expenses and everything, whatever is paid and whatever is yet to be paid, both outstanding and paid is going to be considered in the calculation. Okay. Fine. So with that, we are concluding our today's session. We have done around what, 4 sessions, four questions, 2 full-fledged, and 1 was calculation of some ratio, and another was just calculation of one inventory turnover ratio. Okay. So with that, we are concluding today's session of revising the ratio analysis. Okay. See you next Sunday with the revision for the next topic. Okay. Yeah, Pooja.
सर in this only फिनिश गुड स्टॉक मतलब एवरेज स्टॉक में केवल फिनिश गुड्स नहीं लेना चाहिए था जैसे कि रॉ मटेरियल प्लस परचेज
Inventory turn. If you say inventory turnover, it is all inventories. I didn't say finished goods turnover. Right? So when you say inventory, it includes all inventories.
मतलब टोटल से भी निकाल सकते हैं
हाँ, टोटल से ही निकालना है. अगर क्वेश्चन बोलता है फिनिश गुड्स टर्नओवर, then we will take average finished goods stock.
ओके सर
Okay. Fine.
थैंक यू
So yeah, let's stop here, guys. See you in the next class. Bye, bye, guys. Enjoy. Yes, yes.